Hello, everyone, and welcome back. My name is Greg Furman, and this is the Vantage Point AI Market Outlook for the week of October the 24th, 2022. Now, to get started this week, we'll begin where we always do with the very important US dollar index. Now, the dollar coming under a little bit of selling pressure this past week with a lot of rumors swirling around about the Fed pausing, the Fed not hiking as much. The Fed has not said anything like that. These are rumors from the media. The Fed has said they are going to hike 75 basis points in November. They're not saying they're paring back. What they did say is that they're not going to hike at a rate of 75 basis points forever. And that immediately triggered some dollar profit taking, and we've moved slightly lower. So the immediate direction for the dollar to begin the week is likely to the downside, but that too is likely very limited. We have additional verified support at 110.05. I would look for a possible test on that, assuming that we can break down below the immediate verified low at 111.77 and stay below that particular level. Our neural index strength is down. We have an MA diff cross, and momentum is building to the downside with the predicted RSI. Now, bear in mind that we do have the ECB announcement this coming week, and in most cases, the dollar weakens a little bit ahead of the ECB on Thursday. So this is likely not a long-term move in the dollar, simply corrective, and a buy the rumor, sell the fact on the euro based around the ECB rate decision on Thursday. Now, this is giving some life to gold, but again, we're still holding below that critical T-cross long, 1663. We're still firmly below the yearly opening price, well down on gold contracts on the year. Not a lot of sign of life here, but we do have an MA diff cross that's to the upside. Now, the MA diff cross serves two purposes. Number one, it tells us to stop selling down here near this verified support low, and that we are correcting higher in an overall downtrend, which is indisputable. We're below the yearly opening price at 1829. We're below the monthly opening price, and we're below the Vantage Point T cross long. Now, one of the ways that I would respectfully submit that this can be played, that if there is a gold breakout, what we can do is put a limit order, a buy limit order just above 1663, say around 1670, 1671, because once we close above that T cross long, gold should extend at least back towards the, I would argue, the 1700 mark. But I also don't expect gold to turn into a large uptrend. Remember that if the market is below 1829, the gold market is below 1829, it's difficult to say that it's bullish when we're down this much on the year. So again, we'll watch the verified support low, but I anticipate that will hold this coming week. When we look at light sweet crude oil basically just moving sideways, but as you can see, the yearly opening price and the monthly opening price at 80.47 were stacked. These are stacked up underneath price, providing that very strong support level. We've got a mixed signal here, but an MA diff cross looks like it's about to complete. This could be another warning sign that we're going to see some dollar weakness from Monday to Thursday next week. But again, that would likely be short-term weakness because the dollar remains in a firm uptrend. So for now, the monthly opening price at 80.47, I believe, is a reasonable place for longs, and just make sure that your stops on any trade are below 75.39. Now, when we look at Bitcoin, Bitcoin remains dead flat, waiting for confirmation that the stock market is going to turn. Obviously, we don't have that. So Bitcoin remains flat at 19,423, but it's actually holding up quite well. Now, the main indicators are basically just running flat, sideways. We need a catalyst to either send the stock market higher or send it lower, and Bitcoin will follow. So if the pending move on the dollar is to the downside short term, the short-term move would likely be to the upside on the S&P 500 when we piece this puzzle together. So if we look at stocks, we can see here now that we've closed above the Vantage Point T-cross long, but we've got two verified resistance levels, one high at 1762, but this is the big one here in my respectful opinion. 3806, we need to clear that if we have any shot of getting back up above 3907. And now that is possible, but overall, When we look at the structure, it's always good to look at the long-term picture before you take a short-term trade. So if I back this up and I look at this over the last several years, and I were to use this gauge the market, the S&P 500 over the last 5 years, you can see that this is the first year in the last probably 10, 12, even 15 years that the S&P 500 has never been above its yearly opening price, and we've had a very steep rise. And again, this is a stepped formation as we're going up using that yearly opening price. But this move down is reminiscent of a more of an elevator type move. So again, keep a very close eye on the level I've talked about for the last several months, which is 36.36. We need to get up above that and stay above that level, that June low. And if we can't, there's probably more pain ahead for the stock market. Okay. Now, when we look at some of our main forex pairs, the key one that we want to look at this week is the Euro US. All eyes will be on the ECB, so we'll keep a close eye on that. They are going to hike. Excuse me, but it's more about I would argue it's more about the statement than it is about the actual hike. The hike is a given. Where are they going from here? What does the European economy look like? In my respectful opinion, nothing has changed on that front. So the euro is likely to make some gains next week until Thursday or Friday, and then it will likely resume its very strong downtrend. You can see we opened the year at 113.67. We are down huge on the euro still. So the lower after we get through the ECB, I would anticipate the previous lows around 95.36 are likely still in play. But for now, the initial move on the euro is likely going to be to the upside. The predicted differences, the short, medium, and long are above the zero line. Neural index strength looks good. We've closed only one day, but the T-cross long, 97.99. We want to stay above this level the entire week. Now, if the dollar index drops, then we can expect that US Swiss franc would actually do the same thing. You can see here that we've had a big move up, but it's always rumors that weaken the dollar, right? And again, you had that the market's misinterpreting, in my opinion, what the Fed has stated on Thursday and Friday of last week. All they said was, we're not hiking 75 basis points forever. And that was enough to send the dollar lower. But is that enough to send the dollar from the longer term standpoint? I don't think so. So right now, the T-cross long, 99.44. Keep a very close eye on that. If we can hold above that level, and more specifically, the monthly opening price at 98.72, then this pair can extend higher. But if we lose 98.72, that will confirm the dollar's going lower, and then we would likely be moving into the verified low down in the lower 97 area. Now, the British pound US dollar for next week, this one's messy, guys. My advice is just stand down and wait to see what the UK Parliament does next, who the next leader is. There's rumors going around Boris is making a comeback. I can only hope he gets a haircut this time before he does, but it's a bit of a mess over there right now. So again, I think the pound is going to move sideways and to the downside until they get this organized. The verified resistance high coming in at 114.39. That is the level to keep your eye on the upside, the resistance point. The T-cross long will come in at 112.35. That's our support level. I would anticipate we're going to play both sides of this for the better part of the week. Now, when we look at the craziness, the circus show around the dollar yen pair, this was expected. And quite frankly, I hope the Bank of Japan pays dearly for what they've been doing. So now they've intervened in the currency market, and I believe the market is going to punish them for doing so. So they were whining and crying about the yen was too strong, that they were going to protect the 100 level. They basically intervened to weaken the yen, but I still to this day don't understand why they would bother doing that when we knew the Fed was going into a rate hike cycle. That would alone would endorse the carry trade. So this is a mess that was created by the central bank. And again, my hope is that they are punished for this and the dollar yen goes to 170 to teach them a lesson, to basically stay. It's a free market, stay out of it. But again, we will see. But I would imagine that the Bank of Japan will be on the prowl again next week, watching for any further weakness in the yen, and they're going to try and prop it up. So expect to see a very, very volatile, choppy week with this particular pair. My advice, whenever the central bank is messing around like this, stay out of it. But the monthly opening price is 144.42. The T cross long 146.81. These two levels, if they continue to hold, then the market is simply going to ignore what the Bank of Japan is going to do with intervention to weaken or strengthen. Now they want the yen to strengthen. So again, flip-flopping, if they had just stayed out of it, it would have probably have worked itself out, much like the debacle of the euro-Swiss franc pair years ago when they pegged the euro to the Swiss franc at the 120 level, and we all know how that turned out. So again, be careful with this pair next week. Now, when we look at the US-Canadian pair, once again, when we look at the US-Canadian pair, it has spent the entire week between the Vantage Point T-cross long at 136.62 and the monthly opening price at 138.16. Now, the weekly opening price last week, it moved above the monthly opening price. So we have resistance building up here. We did not retest the new high of the year, which is around 139.77. We did not retest that. So there's a slight bearish bias here. The indicators are pointing down. So if we can stay below 136.78, I believe the US Canadian pair may have a chance next week of moving lower at 135.01, but this will be dependent on the stock market. The same thing is applicable to the Aussie. It's no longer a commodity currency. It's an equity currency, guys. It's tied to the S&P 500. If the S&P goes higher, then Aussie US goes higher, New Zealand US goes higher, and US CAD goes lower. But if stocks are going to have a limited rally next week to say maybe Wednesday or Thursday into that ECB announcement, if they're going to sell off, it will likely be towards the end of the week. So some good possible opportunity here, but keep an eye on this 6407 area. We can see that predicted moving average has slipped below the monthly opening price, and that's usually a pretty bearish setup. But again, it's going to be dependent on what happens with the S&P next week. Predicted differences are rising. The short and medium are above, but the long is still down. You'll see the exact same setup here, guys, but New Zealand is slightly stronger. But you can see this congested resistance here, or congested support. When we look at that and do a comparative analysis to the S&P 500, if we look at this congested support around the monthly opening price, to simply confirm the intermarket correlation between these two, when you look at this on the S&P 500 and bring in that intermarket correlation, you see that same congested support around that monthly opening price. So it does give hope that stocks can move higher, even if it's briefly. Aussie could move higher, New Zealand US could move higher, US Canada could move lower, but all of these trades right now are dependent on that extremely powerful inverse correlation between the dollar and the S&P 500. So with that said, this is the Vantage Point AI Market Outlook for the week of October the 24th, 2020.